Hi there and welcome to October's episode of the Rubicoin podcast, coming to you from the top floor of Rubicoin HQ here in Dublin, Ireland. We've lots to talk about in this episode, but Emmet, before we start all that, you were in New York recently.
I was on the floor of the New York Stock Exchange.
Not floating Rubicoin.
No, not yet, but actually I was there as part of a contingent of Irish companies who are just concluding what's known as the IPO Ready programme, where in collaboration with the Irish Stock Exchange, we went to the New York Stock Exchange to conclude our 18-month programme, and we now have a very clear view of what's required in order for us to float. And I think in the next half year we'll start to prepare paperwork for an intention to float Rubicoin, but it won't be for another 6 years because we are #IPO not ready. It was great to be there. In fact, I was on the floor of the stock exchange at the closing bell, where after which Reed Hastings made his announcement about the Netflix figures, which we'll speak a little bit more about in a few moments.
That's pretty exciting.
Yeah, it was great.
US markets were rattled over the past 2 weeks or so, with tech stocks experiencing a huge sell-off and S&P 500 suffering its worst one-day decline since February. There are plenty of reasons you could pick to explain this: rising Treasury bond yield rates, the trade war that's still raging between the US and China, fears that Saudi Arabia could whip out a good old oil embargo, or even just a classic case of pre-earnings season jitters. But as I'm sure we all noticed, this sell-off impacted the stocks in our Invest app a lot more than February's correction. Why was this so, Emmet?
Well, our stocks have had a huge run. So basically, we have been very effective at picking winners, and winners basically shoot upwards. And when a rain cloud passes by, they tend to drop down a little more. I mean, in plain or kind of technical speak, we seek stocks that are out to change the world, or at least change people's individual wealth profile. So the average market returns, as we all know, comes from the S&P 500, which you can buy. You can buy through the Invest app. And what we try to do is add a multiplier by picking stocks that respond to an upmarket very well. So it's known as a high beta. So if the stock market as a whole moves up, let's say 1%, and our stocks move up 2%, then they have a high beta. Similarly, when the market downturns, the stocks we've chosen may have a tendency to go down a little harder, but over the long run, the stocks that we choose will beat the market. And unfortunately, when market downturns, we will feel it on some of our selections. But short answer is, we've picked winners. They're after flying high. The market downturned, and so too did our stock picks.
So is it kind of a case of high risk, high reward?
Higher risk, higher reward, I think. Not high risk, high reward. I think we've done a very good job at balancing the stocks we select with risk and reward. So I'd be surprised if many of any of our stocks went under. So I don't think that we have a very high risk profile. We really apply the best rigor out there to find winning investments.
So from your experience, is the pain over from this sell-off, or can we still expect a few more days or weeks of this, or can we ever even tell?
I still haven't managed to get my crystal ball to work perfectly well. So it's difficult to say. I mean, there's so many permutations. You touched on some of them there, James: rising T-bond yields and trade wars, and indeed other matters outside our direct control, like Brexit. We don't really know how they're going to affect international markets.
Rising bond yields is something that was mentioned quite a lot, but Rory, correct me if I'm wrong, but I thought if bond yields are rising, the economy's going well.
Well, like when these things happen, you tend to always hear two questions being asked, and the first one is usually, why is this happening? And everyone's always clamouring to answer that question. And this time it happened to be interest rates rising. That was the narrative in the situation. But interest rates have been rising steadily for the last couple of years. I don't know if there's like a magic number where everyone's supposed to simultaneously panic. If there is, I haven't been told about it. But interest rates going up is supposed to be bad for stocks, but interest rates going up also is a sign that the economy's performing well. So that's supposed to be good for stocks. And then you can start talking about, well, inflation's going to go up, which is bad for stocks. But inflation going up could also be good for earnings, which is good. You can do the mental aerobics so far into the future that eventually your head explodes. The truth is, that sometimes stocks go up and sometimes stocks go down. And when stocks go up very fast, sometimes they go down very fast. And that's just what happens sometimes in the stock market. As our head of tech says, it's a feature, it's not a bug.
What's the second question? You mentioned it too. Is it what do I do?
Yeah, the second question people ask is what do I do? And first of all, if you're asking that question, you clearly don't have a plan in place, and you should go and get one. Secondly, no one can tell you what to do. Like, there's a reason we don't give out individual investment advice here, and it's because everyone is different. Everyone has a different tolerance for risk. Everyone has a different goals for what they want out of investing. Everyone has a different time horizon. So, if you're approaching retirement and you are panicking about being over-risked, then you should be doing something different from someone who's 20 years old and has 40 years of earnings ahead of them. And if the last few weeks you found yourself panicking, then that is a clear sign that you need to de-risk your portfolio, possibly get into some more well-established companies, or even increase your cash position, because there's going to be far worse days in the future than what we've seen recently.
Yeah, it really does hurt to see your stocks go down, though, doesn't it?
It does. I've mentioned it before, but I think the best thing I ever read in my entire life relating to stock investing was by Warren Buffett, no surprises. And it was a repurposed piece published in Fortune magazine, and it was entitled Why Stocks Beat Gold and Bonds. And if I was to urge our listeners to only ever read one thing about stock investing, it's that particular piece, because the oracle himself lays out why stocks win over the long term, and he very eloquently explains what are the alternatives to stocks. So when we talk about interest rates are rising, if you bring that down to a very personal example, imagine you had so much money that you had the home of your dreams with no mortgage, you had a car or two of your dreams that have no debt attached to them, and all the other things that you aggregate in life, and as much of stuff as you want, and then you have a whole pile of money sitting in a bank account. That becomes the focus of your attention. Where do I put this cash? And most people realize cash sitting in a bank account that's paying zero interest rate is in fact losing money. So you basically go and seek out alternatives. So when bond rates or interest rates rise, it becomes a feasible alternative to stock investing, but it is not a good feasible alternative, because over the long term, data has absolutely proven without one scintilla of doubt that a stock investing beats all other alternatives. So I would urge everyone to read that piece by Warren Buffett, Why Stocks Beat Gold and Bonds.
Yeah, interesting. So then in the past month or so, it's been overshadowed a little bit by the recent market volatility, but some more big companies have been revealing more big data breaches. First up was Facebook again, who disclosed that about 30 million of their accounts had data stolen by spammers. Alphabet was also on the firing line this month too, killing off Google Plus, but not before quietly admitting that a bug in one of the platform's APIs exposed the personal data of up to 500,000 users. Surprising as it is that Google Plus had 500,000 users, what are we to make of this new landscape where big companies are just revealing hacks monthly?
Well, it's nice that they're finally revealing it. What's so awful about the Google story in particular is, like, this is a company who made $110 billion in sales last year, and the reason they can do that is that we hand over to them a little benefit of the doubt. We sacrifice a little part of our privacy for convenience.
Yeah.
And I think most people are pretty comfortable with that. But, like, in that scenario, the bare minimum they should do in return is at least telling us when our information is compromised, so we can take the actions required to protect ourselves. It's I find it amazing that it's not already law that you need to immediately report these things, because so much of our lives are now in the digital realm, and there's so much damage that can be done if that information falls into the wrong hands.
So you mentioned that it's nice Google have told us about this hack now, but when did it actually happen?
Like, this happened back 6 months ago, so this was going on sort of around the Cambridge Analytica thing, which you mentioned earlier. And I want to, just on that, the Facebook hack that happened as well this week was actually a hack.
Yeah,
I think people are kind of conflating the Cambridge Analytica thing with the hack that happened 2 weeks ago. The Cambridge Analytica thing was, like, by design. The hack that happened, the 30 million people who got hacked recently, was actually a breach of data. And this is the kind of world we live in now, where we don't even know what a hack is anymore. There's so much information out there, and it's so available to people, and companies just aren't doing enough to protect people on so many levels.
Yeah.
I like the way you used the word conflating there, Rory. That was quite a nice word. Well done.
Thanks.
Some other big news from Facebook recently as well is that they've hired Nick Clegg as their Vice President of Global Affairs and Communications. Maeve, we've had a chat or two in office about Facebook hiring Nick Clegg. Who is he for any of our listeners who might not really know who he was?
I can just tell you that the reason that he was ever on my landscape is because he did something that I always remembered sticking out as highly unusual and, you know, fairly controversial when he was the leader of the Lib Dems in 2010, and he announced that he would abolish tuition fees. And to the best of my knowledge, actually what happened was a complete U-turn and a video apology where he said, sorry, we may not abolish them, we may in fact triple the fees. So about as big a U-turn as you can get. I don't know a lot about his kind of personal presentation or, you know, his actual work since then. But I mean, that news last week was slightly unusual. Seems like a strategy. I mean,
so are they saying he's a politician?
He's definitely a politician.
And he lied? He did a U-turn?
Yeah, I know, right? So that happened, and like my question would be, what exactly do Facebook think he's going to do for them? What gloss is he going to give to their policies, you know, to their security, to their comms? He's a knight, so is it just that he's going to add legitimacy, British legitimacy? I'm not sure.
I do think the European angle here is important to Facebook because from what we've seen in the States, there's just no political will to regulate these companies, whereas over in the EU, I'm going to mess up her name now, but Margaret Vestager at the EU Commission for Competition has just been nailing the big tech companies, Google in particular. So it would be good for Facebook to have someone with some connections in the European Parliament, I suppose.
You may bet.
Sure.
Yeah. We're at the start of earnings season now, with most of the companies in our Invest app getting ready to report over the next 2 weeks. One company that's already reported, though, is Netflix, who smashed earnings expectations last week. Expectations weren't actually as high for the company going into the earnings call, but a big beat on numbers, especially in terms of subscriber growth, sent shares up more than 10% last week. Emmet, as a long-term shareholder in Netflix, what are your thoughts on their recent performance?
I'm very impressed. I remember the day where Reed Hastings, the founder and CEO of Netflix, said that someday Netflix as a service would have 10 million subscribers, and that was at a time when they were posting out DVDs. In the past quarter, they gained, their subscriber base grew by 7 million, or almost 7 million. So what that equates to in those 12 weeks, they're adding 500,000 subs per week, and that's absolutely incredible. And in the last 5 years, since September 2013, Netflix has added 100 million subscribers. So really they're a juggernaut of entertainment. What was interesting about the announcement from Netflix was that they are planning to borrow another $2 billion to help pay for exclusive seasons and series and movies that the management say creates a barrier to entry and a differentiator, and absolutely it does. And Netflix are more than aware that Prime and Hulu and Disney and other competitors are coming into the arena, so they're basically building up their inventory of unique content, and $2 billion buys a lot of content. I think the question that arises in an investor's mind is it $2 billion well spent? And really it's all down to the quality of that inventory, of that content. Does it acquire more subscribers? Does it retain the subscribers that are already in? And I happen to believe it very much will prove to be the case. So the debt that they're incurring will return far more than the number they've just borrowed.
So no worries about debt coming back to bite them down the road?
I wouldn't say no worries. I mean, nobody likes debt per se, but it's the way you supercharge your business, especially when you're in a race and there's a competitive race going on between all the big providers of home entertainment. So you need to get your quality content sooner and out quicker.
Over the last few episodes of the Rubicoin podcast, we've started asking you to vote on some of the segments you'd like to kill or keep for the next episode. We're doing the same again this month, and to start off, we're going back to our companies we never talk about section. This is where both Emmet and Rory pick a company from the Invest app that they feel doesn't get discussed or talked about as often as it should. Rory, we'll come to you first today. What company from the Invest app would you like to shine a little more light on?
So it's not even that this company doesn't get talked about enough. I don't even think we've ever talked about this. But amidst the brick and mortar retail apocalypse, this stock has been on an incredible run. It's Costco. It's a very boring business. They do warehouse wholesale, but the stock's up over 40% just in the last 12 months, which is, impressive for a company that's not in tech. It's not a software as a service company. It doesn't even sell marijuana. And it's not that it's up 40% after a big dip in the stock price or anything. It's been pretty much on an uninterrupted run since the bull market began. Last year, they posted same-store sales increases of 9.5%, which is impressive for any retailer in this environment. They also saw a 32% increase in their online sales. Memberships, which is where they make 75% of their profits, they actually increased prices last year, but saw increased renewals. So I think it's a company that's overlooked a lot, but you got to remember they've got 94 million people paying them subscription. And as we've seen with the likes of Amazon Prime, once you have those paid subscribers, there's a lot of options available to you. So I like the company, I like the management, and I'd like to see what they're going to do in the future.
Yeah, they're really an outlier in the bricks and mortar retail space now at the moment. That's been kind of so hammered.
Yeah, absolutely.
What's the subscription?
You pay a yearly subscription for membership, and then you go in and everything's a bit cheaper than you get it in the grocery store.
Better deals.
Yeah,
First look, kind of.
No, not necessarily first look, but you can buy things in bulk. It's not really a concept we have over here.
Yeah.
Do we have? There was a company. No,
There's Musgraves, but
Musgraves. Yeah,
it's not even retail. That's actually B2B.
yeah.
Yeah,
Okay.
we don't have it over
So
here.
this is
in
kind of
little Ireland.
B2C Musgraves style subscription.
Correct.
Exactly.
Yeah.
Okay.
Interesting. Okay, so Emmet, what company would you like to shine a little bit more light on today?
I'm going to go with Casey's General Stores. Casey's is a stock I've rarely thought about beyond when we first handpicked a short list of stocks to add to our Invest app at first.
Yeah.
Casey's own and operate about 2,800 convenience stores across 14 Midwestern states. And basically what they sell is gasoline, some grocery items, and a whole bunch of freshly made pizzas and donuts. How Casey's differentiate is they look at underserved towns, and 57% of Casey's stores are found in areas with a population of 5,000 people or less, which is an area is kind of not appealing to Walmart and the other competitive giants.
Yeah.
So they're playing out a battle in a blue ocean strategy. They're going and looking at places where the big giants are ignoring, or at least less focused on. So we added Casey's to our showroom in 2016. It's been fairly flat as a stock. So, however, they're starting to implement a turnaround, or not quite a turnaround, but an improvement in the business, and we can start to see it cut through. So, they are in a new value creation mode, and how they're doing that is they're using their big data to improve sales and margins across their stores. They're cutting on costs, they're buying back stock, and they're increasing dividends. And what's nice about Casey's is they have increased dividends for 17 consecutive years. So we're buying a business that's an old world proven model. They know how to make money, they're increasing dividends, and they have ambitions for growth. So while it's certainly not the most glamorous stock in our showroom, it's one that we believe will be a steady eddy and keep returning and paying dividends every year.
And I heard they have great pizza too.
At one point, they were like the third or fourth biggest pizza supplier in the US, which I thought was crazy.
Like 1/3 of their revenue comes from pizza.
Yeah.
I mean, that's incredible for a gasoline chain.
Pizza and gas.
Yeah, pizza and
It's
gas.
like if you're in that area, like where there's like if it's a town under 5,000 people, there's probably not a huge amount of options.
Exactly,
So
yeah.
If it's good pizza, people are just going to go to the
Has
convenience
anyone
store.
ever had their pizza?
No.
Fortunately not.
No.
Someone from the Midwest send us some.
Yeah, please. Big pizza fans.
We'll include the address at the end. So that was the companies we never talk about section. The next section we're going to revisit is I read a book. This is where one of our investing team proves that we can read books and discusses a book that they read recently that helps them to think a little bit differently about investing or the world in general. And you actually gave us a small taster of this book in last week's episode, so I'm going to let you introduce it.
Sure, it's Shoe Dog by Phil Knight, who is the founding CEO of Nike. I think this year, for me, is defined by a lot of different themes, and one of the themes for 2018 for me was my year of books. I managed to consume more books this year thanks to Amazon's Kindle and Audible services than I would say 5 years prior. So I think I've milled through about 30 books so far, and I very much enjoyed Bad Blood, which you covered, James, in a previous edition.
Yeah.
But what clearly my favourite book of the year was Shoe Dog, and it is the autobiography of a man who arguably was to sportswear what Steve Jobs was to consumer electronics. Philip Knight, or Phil Knight as he's known, and is co-founder of Nike, basically started in Portland, Oregon, and it's really a story that has a backdrop of business, and it's the story opens about his youth in Portland, where as a runner back in, I think it was the 1960s or even the 1950s, it was so unusual to jog that people would slow their car down, roll their window down and throw a soda can at you. You're just seen as this strange freak on the out fringes of society. So he basically had a passion for running, and clearly was very effective in his pursuit to build his business. So basically, Knight approached Bill Bowerman, who was a running legend of Portland and Oregon and had trained many Olympians and champion runners. And Bill Bowerman himself was this innovator who, as the book explains, would experiment with anything and everything on a runner's foot to try and improve their performance, ranging from creating new soles with his waffle iron in his garage right through to strapping fish to the feet of runners. So the guy was out there.
Well,
and
whole fish.
Isn't that right, Rory?
I must have missed that.
No, he did. He said that he was experimenting with strapping cod to the soles of feet. Now, I'm sure there was a little more to the story. The story is wonderfully told. In fact, if you consume it via Audible, as I did, you get to hear the opening chapter read by Phil Knight himself. Okay. And I particularly liked the narrator's voice in the book, and there's moments of real tension as you go through it. You realise that the route to success for every business is a zigzag, and there are multiple points along the road of any business where it could fail at a moment. And it was very, I related to the book, not because Rubicoin is by any means at the level that Nike was at. We have ambitions to become as big as Nike in our own space, but we certainly, it was just an eye-opener as to, it's a story of industrial espionage, international mystery, and basic love and love lost, and it's a wonderful book. And towards the end, Phil Knight talks about going to the cinema with his wife and bumping into Warren Buffett and Bill Gates, as you do. Yeah, exactly. And I think what the book really did, or what that particular moment did for me, was it illustrated how he is a legend in the same right as Buffett and Gates, just a lesser known legend. But I think this is a book that everyone should read, irrespective of age or interest in business and investing. I think it's very readable, very enjoyable. It's a lovely story, and it's one that I'm definitely going to reread.
Is that why you wore your Nike t-shirt today in honour of it?
Yeah, absolutely. I swapped out my whole wardrobe for Nike only.
You have to say, I'm halfway through reading it, and I really enjoy it. It's like you said, it seems like there was so many moments where that business was just going to go under. It's like every chapter you're like, oh, is this how it ends? And then you realise, no, of course it doesn't.
But even how they chose the name Nike, I mean, the business was called Blue Ribbon right through, and they, for reasons that you'll learn when you read the book, they needed to change the business name, and it was done in such a scrappy way. Like the word went out amongst the team in the office, look, we need a new business name, and everyone threw in an idea. And at the 11th hour, where Knight just had to choose a name, he just said, oh, look, go with Nike. And it was just so like, and you think of Nike as now is a cultural icon, if you like. It's burnt into the mind of pretty much everyone in the first world, and yet its name was chosen on a dime. It was just literally, okay, look, we'll go with Nike, run with it.
Speaking of names, Shoe Dog, is there any further light to kind of shed on the book title?
He explains a shoe dog now. Actually, let me just recall. A shoe dog is somebody who is just absolutely dedicated to running, and particularly his interest in their footwear. Right. So if you're into the ergonomics and the engineering of a shoe, you're a shoe dog. Okay. And it was a term within the industry, and he refers to it a few times.
Okay, because the title grabbed me.
Yeah. So if you're a shoe guy or gal, you're a shoe dog.
Cool.
So that is Shoe Dog, as we've said about 10 times there, by Phil Knight. So the last section we're going to chat about is Jargon Buster. This is a relatively new section where the team takes a look at some of the more confusing parts of investing in the stock market in general and tries to make a little more sense of them. One of the first things I'm going to come to here is a company we had in the Invest App showroom until very recently, Mazor Robotics. Early last month, or in the middle of last month, they were acquired by Medtronic. And we had got a few questions in from investors asking, what this acquisition meant for them. Rory, do you want to talk a little bit more about that?
Yeah, first of all, I can't believe it's only been a month ago. It seems like forever ago. But so Mazor Robotics was an Israeli company who made robotic surgery machines for robotic machines.
I believe that's the technical term.
Robots.
Also known as robots.
Robots for to assist surgeons with back surgery. And Medtronic has agreed to pay $58.50 per share for the company. Medtronic, one of the giant medical device companies, already owned about 10-11% of the company. At that point, they'd signed a global distribution deal for their biggest product. So it kind of wasn't a big surprise that they ended up just buying them outright.
Yeah.
Unfortunately, it was for a much lower price than we kind of hoped for. I thought that was going to be a great double or even triple bagger over the next year or two.
Absolutely.
So felt a bit hard done by.
Yeah.
And I think a lot of shareholders did as well. And we got a lot of people messaging asking, is there anything they can do about this? And the truth is no. There's nothing you can do.
I mean, what Medtronic saw in Mazor is what we saw in Mazor, and very often businesses are bought out because their prospects are wonderful and great, and that's the reason that we've added them. I think at this stage is probably the 5th stock bought out of our showroom. So obviously other suitors spotted them as well and have far deeper pockets than our collective community.
Yeah, I mean, sometimes when you see a company being acquired for less than you were expecting, you might see a kind of bidding war start. That happened with Juno Therapeutics last year, and they got a nice premium. But with this, there's already a global distribution deal in place. They already own 10% of the company, so it would be unlikely that any other company would come in and try and outbid them. And unfortunately, unless you're a major stakeholder who can summon the will of the other shareholders to block it, there's absolutely nothing you can do. What is there? You knew the phrase for that. Is there a phrase for it? Being dragged along?
Tag and drag?
No, maybe not.
No.
Okay, forget it.
Another question we got in recently through Twitter was, what is the team's opinion on technical analysis in relation to long-term investing?
When you start your investing life, you have to pick a strategy.
Yeah.
And what we've done here and what we will continue to do here in Rubicoin is we evaluate businesses under two lenses, a qualitative and a quantitative lens, or you could say the art and science, or the right brain and the left brain, whichever way you want to put it. But we look at a business qualitatively, like is the stuff they produce beautiful, good? Do they have a great leader? Does it create customer evangelists? And has it got a high NPS? These are kind of the qualitative attributes of a business. The second family of attributes we look at are quantitative, and they're attributes that can be measured with a number, very often the balance sheet and sales growth and insider ownership numbers.
Yeah.
But there's a third family of attributes that one can decide to look at, and that's basically technical analysis. And when you go that route, you generally don't care what the business does. You don't care if they're in the business of making movies or making steel ships. Frankly, all you're looking for is a trend line that is favourable based on the strategy you've decided. I don't know too many investors who are both long-term investors and technical analysts, as in they're bringing together a formula for long-term investing purely on technicals. So it's a family of study, or it's an area of study, I should say, unto itself. There are countless books written about technical analysis. And you'll often hear terms like MACD, moving average convergence, divergence, and candlestick indicators. And, it's quite interesting. And I think it's technical analysis is almost something you'll end up being curious about as an individual investor, but you'll also, personally what I found is that success lies in the areas that we have applied here in Rubicoin, which is looking at the qualitative and quantitative numbers of a business and buying for the long term. Very often technical analysis will ignore something that's far, far more important. So we could probably find a listed pager company with great technical and charts, but frankly they're in the business of pages.
Another question we got in for yourself, Emmet, was about your own personal portfolio. So in the expert opinion pieces we regularly publish in the Invest app, you done a deep dive, I suppose, into your portfolio and compared it on a year-on-year basis, and one of our Invest community noted that you sold some stocks recently. So I know there's no there's no final formula for selling stocks,
Yeah.
but do you want to give maybe just a quick overview of some of your thought process when you go into selling a stock?
The first thing I'll say is that I have, for the last 6 or 7 years, always tweeted what stock I'm buying just before I buy it and what stock I'm selling just before I sell it at Emmet Savage. And there's a little padlock on it, but send me a request, I always approve it. So firstly, I like to keep a very open record as to the rationale behind all my buys and all my sells, and that's available for anyone who wishes to follow me. There's 101 reasons why you'd sell a stock. In fact, it's been measured that you cannot read into the reasons, the rationale for selling a stock. Even insider sales are far, far less informative than an insider buy in a publicly listed company. So when I sell a stock, it usually comes down to a couple of reasons why I would do so. Number one, I found somewhere else for that capital to go that's more favourable. Second reason would be tax planning, and I'm a resident of Ireland and I am subject to Irish tax laws, which the vast majority of our listeners are not. So there is a sponsoring thought in my mind that really you'd need to be in my mind or in my Twitter to understand. Another reason is that actually that's two, isn't it? Really, some are better than some are better for capital, or basically I have to settle a tax bill.
Yeah,
but that's our. I suppose the third is personal financial planning. Just need cash for something else. So really, they're the three reasons that I will generally sell, and I would urge someone. And always, don't copy me. I'm delighted to tell people what I'm buying and why, and what I'm selling and why. But I'm not trying to be the Pied Piper here and tell people or suggest people that this is what they should do. I'm simply keeping a public record of my own choices and why.
Cool. And then one final question we got in this month is for yourself, Rory. So, Stock of the Month is a feature we have in the Invest app once a month, surprisingly enough. But we had a user in asking how exactly we pick Stock of the Month.
Yeah, that's a hard question to answer because there's not one or even two or three things that we look at when we decide a Stock of the Month. Every month we add a new stock into the showroom, and that's something that builds up over a long period of time by having a group of stocks on a watch list and looking at them carefully and deciding which one we think is the best opportunity at the time. The Stock of the Month is more a kind of retrospect on stocks we've already added that we already like, and just what one is really singing to us at that time. And it could be for a number of reasons. It could be, an interview we heard with the CEO that really roused or kind of inspired us about the company. It could be a recent earnings report. It could be that the stock's pulled back a little bit, whereas 20% ago we might have thought it was at a premium price, and now we think that it's more fairly priced. So it's usually a big mixture of things, and what we typically do is we have a loose enough system of kind of firing back and forth ideas to each other over the course of a month, and eventually we tend to end up with 2 or 3 companies that we're really liking, and we make a judgment call on that one.
Cool.
Could you think of it as more of a spotlight than a prize?
Yeah, I would. I wouldn't. It's not like the day we publish Stock of the Month, you should buy that stock right away. What we're trying to do more than that is to give an insight into how we research stocks and what we look at when we're looking back at a stock that we've already recommended in the past. So it's more of an insight into the process than buy this stock right this second, or here's reasons why you would like a stock at this time.
Because a customer, I think, was speaking to me recently and just commented on the fact that they had bought Stock of the Month once and saw that stock was Stock of the Month again. And I think that that's helpful for people to understand that it's us putting forward a stock in the moment, not because it's that month.
Mm-hmm. Yeah, exactly. Well, I'm not sure we've done Stock of the Month twice for the same stock. Perhaps we did. Maybe it was recommended, and then it became Stock of the Month a few months afterwards, or something like that. But again, it's a different thing. Might seem like the same thing, but it's not. It's a different process and a different way of kind of evaluating stocks, the way we do things.
Sure.
We're running out of time in this week's podcast, but I just want to quickly get to the elevator pitches before we finish. So this is a quick 30-second pitch that both Rory and Emmet give myself and Maeve about a stock centred around a proposed topic. So the topic this month is, considering the last few weeks, is a stock you'd buy on the dip. So after the last few days of volatility on the market, which stocks are looking more attractively priced to you? Rory, we'll come to you first.
Yeah, so the
30
stock
seconds.
I would buy on the dip, and actually did buy recently enough, was Twilio. Twilio are the makers of communication platform that allow companies to talk to you through your mobile phone with voice, chat and video. They recently made their biggest acquisition ever, SendGrid. They spent $2 billion on it. It's a company that sends out emails. That might sound like a lot, but Jeff Lawson, who's the CEO of Twilio, is a real superstar in the Valley. He's been the founder of a number of successful companies, was leader at Amazon for quite a while, and I'm sure he sees something valuable in SendGrid, and I think he'll be a great company going forward.
So that stock again is?
Twilio, it's TWLO.
Cool. And then, so Emmet, what stock is looking good to you after the last few weeks?
Well, I'm feeling very excited about Atlassian at the moment, the Sydney, Australia-based kings of collaboration software. Should I say
What a
that with a
tagline.
drink on board? So Atlassian was absolutely hammered in last week because it had a non-cash charge of around $250 million, which was based around the revaluation of debt they had. But this is a once-off occurrence. When we look at the big picture for Atlassian, they have the most kind of comprehensive and readable investors presentation I've ever seen. And if you go to Google and type in Atlassian IR Investor Relations and click on the IR events and presentations, you'll see that very PowerPoint that I'm referring to, but you'll see a wonderful set of illustrations on how incredibly powerful and sticky the Atlassian tools are. And only 2 days ago, they announced that they had over 130,000 business customers. They had added nearly 6,000 customers during the last quarter. Subscription was up 55% year over year. Maintenance revenue was up 22%, and perpetual license revenue was up. They increased their cash position to 1.8 billion from 1.7 billion. Like, every number you look for in a great investment was positive for Atlassian, and yet the stock was slapped down because of a once-off charge related to their debt. I think it's a wonderful stock. I own it. I'd buy more if somebody walked in the door with it and gave me either $1,000 or 10,000 or 100,000. Right now, I'd put it into Atlassian.
Okay, that's pretty powerful. Maeve, we'll go to you first. Which would you pick? Which of the pitches?
Atlassian,
Atlassian.
because we use it in-house and I have peers that say they need it. Tech teams particularly. I know we have Confluence, I think,
Yeah.
which is the actual task collaboration tool.
Yeah.
Jira, can't get my head around it, but some people that I trust tell me that it's necessary, so I'm going to go Atlassian.
Yeah, I think I'm going to go with Twilio. 2 billion seemed like a lot for an email sending platform, but then doing the emails in here a lot, you can see how frustrated you can get to. So that's about all the time we have for in today's podcast. As usual, we want your help in deciding which parts to kill and keep for the next episode. If you go to our Twitter page now, you can vote on the 3 sections. That's companies we never talk about, I read a book, and Jargon Busters, to let us know if you'd like to hear it again next month. If you miss out on the Twitter poll, you can still let us know what you think. Get in touch with us on Twitter and Facebook. Leave a comment on the podcast itself. Message us through either the Learn or the Invest app, or email us at pod@Rubicoin. That's pod@rubicoin.com to let us know what you think. If you have any other suggestions for brand new sections you'd like to hear, we'd love to know too. That's about it for us this month. As always, there's plenty of new things to check out in the Invest app. We have a new star stock of the month, and expert opinion piece for October, so make sure to check them out in-app. Thanks for listening in, and please make sure to rate, review and share the podcast if you enjoyed today's episode. For myself, Emmet, Rory and Maeve, happy investing.